So something just broke in the markets today with the Fed. And I think you need to know this because I think we're in the very early innings of what could be to come next. Now, I could be right, I could be wrong. We are just seeing some very bad signs out there. And the sooner you get this information, the sooner you can profit from this. We were calling out this panic that could happen after this Fed meeting. We've been talking about that for days, and look what just happened. The markets collapsed. And there's a very clear narrative that is coming out of all of this. The Fed is going to push us into a recession, and that recession could actually be happening right now. We have Nick Timmerhouse that spoke on CNBC actually before the Fed for a couple of minutes, and he thinks the Fed is going to be the problem for the economy. You also have Jeffrey Gundlach that says, no, the Fed is not going to be cutting in the first half of next year. They're going to potentially be doing double rate cuts or more in the first half of 2024. This is way different than what markets are currently expecting. Now, why is this? Well, it looks like the Fed is officially asleep at the wheel. So I'm going to give you the 3 things that the Fed said today that spooked the markets, how this could affect the markets, and what could happen to Tesla stock, as well as the broader indexes. We're going to look at things like oil, bond yields, how to potentially position any kind of hedges that you have, because this does not look good. We also have some pretty particular news on Tesla stock. The lawyers that crawled back that $700 million that was apparently overpaid to board members at Tesla, they want over $10,000 an hour for doing so. Yeah, believe that. We have other news as well, including the strike, which, could be getting worse here in the next couple of days, including over 2,000 new layoffs from Ford, GM, and Stellantis. We have all of this and much more for you here in this video. Hit the like button and subscribe to the channel if you are here, if you are listening to my voice, if you invest in Tesla, if you like Tesla, or at the very least want to stay up to date with everything going on each and every single day in our markets. And to be quite honest, have a heads up. We're making these videos before anyone else is. So hopefully it helps you make money. There is 3 things in particular that the markets did not like about what Fed Jerome Powell just said, and you need to keep note of these. Number 1, the neutral rate long-term could be higher. Now, this short-term, is causing some panic, like if interest rates go back to 2%, maybe Fed funds rates have to stay at 3%. That's kind of what the markets are thinking. But that's more of a longer term. Once we start cutting rates, once inflation gets to 2%, that's more of an issue then, in my opinion. The second thing that Fed Jerome Powell said, I think is much more important right now. It says a soft landing is not Fed Powell's base case. And we'll come back to highlight this quite a bit. Number 3, if the economy continues to perform well, the Fed will do more. So, Google actually says, Fed Jerome Powell said, quote, he wouldn't consider a soft landing for the U.S. economy to be the central bank's base case. If you look at the summary of economic projections, the Fed, the committee members, are expecting 1.5% GDP for next year. For 2025, they're expecting 1.8%. And for 2026, they're expecting 1.8%. How is your base case not a soft landing? Let me break this down for anyone that is unfamiliar. In investing, you have your best case scenario. Like if everything went well, what would happen to the share price of a stock? That's your best case. Usually not your most likely. It's your best case. Your base case is what you actually expect, what you think is plausible and reasonable. That's usually what you base your investment thesis on. Your base case, what you expect to happen. Your worst case is obviously if everything went wrong. So Fed Jerome Powell said a soft landing is not the central bank's expectation. They said we're going into a recession. That makes you question the whole summary of economic projections. Because if you look at the summary of economic projections, things look better now than they did before. The Fed increased their expectations for GDP next year from 1.1% to 1.5%. They kept their 1.8% estimate for 2025 and brought on a new 1.8% estimate for 2026. The central bank also expects the unemployment rate now to be at 4.1% by the end of 2024. So they're not really expecting a spike in unemployment, something very manageable. They're expecting higher GDP. Inflation is expected to stay the same, and they're expecting higher Fed funds rates. But yet, Fed Jerome Powell just completely said the opposite of what the central bank claims to have just put out there in the summary of economic projections. Fed Powell just lost a lot of credibility, or he did not mean to say that. Maybe the central bank is playing a big bluff here. That's what the markets are saying. If you really want to boil it down, the markets are saying, hey, if your base case is not a soft landing, then why did you just raise your GDP estimates? Are you trying to break the economy? Because it doesn't take a genius out there to realize the economy is not doing okay. It's not doing well. And you are seeing the same signs you typically see during past recessions right now. Like in energy prices, specifically oil. Oil has actually went up about 35% since June, presumably for no reason at all. And this usually happens right before a recession. A matter of fact, since post-World War II, recessions in the United States were always preceded by or accompanied by a sharp increase in energy prices relative to the aggregate price level. So energy spikes, you go into a recession. Every time. Look at '08. Same story. You spiked in a very short amount of time from about $90 a barrel to over $140 and then came crashing right back down. Rise in energy prices, well, that obviously affects inflation, in which we're faced with inflation right now, but it mainly affects people's spending power. So it really, during a weak time for the economy, just period, and then you get a rise in oil prices. That's like the cherry on top of the economic disaster sundae. And that's what is happening right now. This also rings a couple of bells. The 2007-2008 Writers Guild of America strike. That's what's going on right now. And they've been striking for about 2 months now. What about the yield curve inversion, in which if you look at the 10-year and the 3-month yield curve inversion, it has been going inverted since October of 2022. This one is very important. Now, you usually don't see stock market weakness until you start to uninvert, until this chart starts to rise. When it starts to rise, that is usually telling you you're in a recession or you're very quickly going into one. Let me pull this out as far as we can possibly go. Let's type in 1950. It takes us to 1982. When you go inverted, usually not a problem. But when you start to uninvert, you can usually uninvert pretty quickly, and it's right before a major problem happens in the economy. Even back here in 2019, during August and September, you were inverted. Couple months later, you were in the Rona crash. And look at the 10-year and 3-month yield curve inversion. Is the Fed ignoring this? Certainly looks like it. The Fed has their own projections. Powell says we're going into recession. That's what he's literally saying. But the dot plot says something totally different. This is a big problem. Big problem for the markets, trading close to all-time highs. When you also think about this logically as well, history tells us that you usually don't go into recessions when everyone expects it. So if you look at some of these articles, back on May 25th, Jim Cramer says, advice for how to invest during a recession. June 19th, 2022, bear markets and recessions happen more often than you think. July 22nd, what a recession means for your long-term portfolio. These articles, the topic of conversation about a recession in June, July, August, October, September of last year, I mean, we're everywhere. Everyone was talking about this recession we were going into, and most people predicted it for the start of 2023. Well, now we're gearing the end of 2023. There has been no recession, and since May, everyone has gotten bullish. Even today, investors are very bullish. You usually see this right before a recession. This is not rocket science. You usually see fears of a recession, the fears calm down, the bears capitulate, they go bullish, and then you get the recession. Almost every single time. Take a look at what Jeffrey Gundlach just said about the markets and about the Fed. He expects the Fed could be cutting rates a lot sooner than what they expect. And overall, if the Fed's, again, base case outcome is not for a soft landing, that means the Fed's base case outcome is for a hard landing and a recession. That means they're going to have to cut rates. And I personally think this SEP, Summary of Economic Projections, was a big bluff. Big bluff by the Fed. They want something to break. They want to crush inflation. They want the economy to break. That's the bottom line. And guess what? The stock market finally figured it out. We are heading into a recession. That is why stocks sold off as aggressively as they did towards the end of the day today, because they realized the Fed's BS, essentially. The Summary of Economic Projections means nothing. Fed Powell showed his cards. He showed his hand. And it's not a good one.
Well, I think you've been looking for cuts next year. I mean, are you rethinking your outlook for rate cuts based on what the outlook today said?
Not at all. I think it's quite likely there's going to be rate cuts in the first half of next year. And I think they're going to be bigger than the Fed thinks as their base case. So I think we have real rally potential in the long end of the bond market. So the way you positioned, Judge, is really pretty simple. It's the same that I've been advocating now for a while. You want that profit potential at the long end of the Treasury market to help hedge your risk positions. But where you really want to be in bonds is not T-bill and chill, which is the new rhyming phrase that people use about investment strategy, because you can buy the 6-month bill at $5.50. But I wouldn't do that. I would go more into a 2 to 3 year type of portfolio in credit, where you can get 7.5%, 8.5%, 9% yields. I mean, bank loans in the double B sector, they have yields that are up in the high single digits. And the Fed not cutting anytime soon means you're going to earn that yield for a while. So this is a market where we want a long-term position, kind of a core position in treasuries for a fixed income portfolio. And then you want 2 and 3 year, because that's the peak of the curve, the 2 and 3 year in the securitized credit markets, where you get these big yields. And so you can end up with a pretty sleep at night type of portfolio that throws off income that's probably triple, if not 3.5 times that of the equity market.
Optimism of a soft economic landing. But he says there are 4 things standing in the way of that. Joining us right now is Nick Timmerose. He is the chief economics correspondent at the Wall Street Journal. When he writes things, people read it. They listen because he has been very right on the Fed for very long. Nick, I think you concerned a lot of people recently when you said that, a soft landing always looks like that at the beginning, but it's really hard to really nail that. It's something that's pretty elusive. What got you to this point? Why are you writing about this now?
Well, you look back at this point in the cycle when people think the Fed is done or close to done raising interest rates. The economy looks okay. You don't quite know yet if the Fed has done enough to put it into a downturn. And so there's a lot of optimism about a soft landing. It's like a Hail Mary football pass, right? When the ball's in the air, a lot has to go right and a lot can go wrong for the receiver to take that ball in the end zone. But you think maybe this time it's going to work out. And so I think that's where we are right now. And the piece was just sort of a way to look at what are some of the things that have to go right and what could go wrong here. I mean, what could go wrong is that inflation could pick back up, growth could reaccelerate, and you could have more concern about reacceleration. On the other hand, the Fed could be the obstacle to the soft landing in that they're saying they want to stay higher for longer, Becky. And so that means maybe not easing as quickly. And if you look back at the few examples that we have of those successful soft landing, Hail Mary receptions, the Fed was cutting interest rates and taking back some of the increases they had done. So I think those are the two main concerns here.
Hey, Nick, don't look now, but when people say Volcker, or when people say, remember what happened back in the old days when we went to 21.5%, it's different this time, people say, because, well, we don't have the oil shock that we, and then all of a sudden, wait a second. And they say, well, we don't have the wage price spiral. We don't have unions emboldened and asking for, well, wait a minute. I mean, suddenly some of these things are starting to look a little scary. And you remember the stop-start nature of the Fed back then before Volcker, which allowed it. It never put it to bed. It never got the stake in the heart of inflation. And he had to come in and go crazy. I mean, it's starting to look maybe like it's not quite as different as we thought it was from back in the 70s and 80s.
Well, I think that's a great point you raised with stop-go, because it speaks to the importance of luck in some of this. Of course, you can make your own luck. But look at Volcker. In 1982, inflation was still above 4% when he sort of called the dogs off and said, all right, that's enough. He abandoned the monetary aggregate targeting that they had put in place because he thought he had done enough, even though inflation, it wasn't all the way back to zero, right? And then they had to start hiking again in 1983. So you could say, well, was that stop-go? Obviously, they got help from the supply side as things went on there, and so I think that is important. What happens in the developments that are outside of the Fed's control could play a role here in whether we get kind of a mild recession, soft landing, whatever you want to call it.
Because no one's saying 8%, much less 9, 10, 11. I mean, we're saying another quarter point, worst case scenario.
Well, I mean, look at where we've gone on inflation. I mean, we've now had, next week, we'll probably see a third very mild core inflation reading. You'll be looking at, 2.5% core PCE inflation on a 3-month annualized basis. So it's hard at this point to compare this to the 1970s or 80s.
So your analysis at this point, is this an argument for the Fed to kind of stand pat and wait, look around, see what happens?
I think so. I think the question here is, if you cause a recession here and you're the Fed chair, you're Jay Powell, is someone going to thank you for causing a recession because inflation was high 12 months ago, right? A year ago, you look at where we were, 8% inflation.
Too.
Well, no, I mean, we had a lot of years of very high inflation. So people eulogize Volcker today because he fixed what had been a years-long problem. And if we have 2 years of high inflation and now we're looking at, 3% next year, that's different from what we faced in 1979 or 1980.
Nick, I'll ask you a couple quick questions. First of all, what's your gut tell you? Do you think that the Fed is going to keep rates higher for longer? Because there are a lot of market participants who aren't really agreeing with that, who think it's going to come. Rate cuts will come as soon as the end of this year, even early next year.
It's impossible to tell. I mean, you tell me what's going to happen in the economy. Look at what happened in March. Powell puts 50 basis point hike on the table, and then we have a regional bank ruckus, maybe not a full-blown crisis a few days later. So it's impossible to tell. But what I would say is, if you look back, Becky, at where we've been over this cycle with the Fed always kind of on a different page from the market, that's changed since July. The tightening that you've seen, the long end rising, the market expectations now much closer to what we're going to probably see in the dot plot at 2 p.m., that's different. That's really the first time we've seen the market and the Fed really on the same side here about, when you hit the peak rate, but how long you hold. And so that provides a little bit more tightening of financial conditions, which is what the Fed wants to see. I mean, just this morning, 7.3% 30-year mortgage rate. We've now held mortgage rates above 7% for several weeks. We haven't done that, before August. So this is a different environment.
The other thing I'll say is that we keep talking about it as if the interest rates are their only tool. It's kind of like thinking that this is an automatic car. This is really more of a manual driving situation, because you've also got quantitative tightening. We never talk about that. It's another tool they can use. Which do you think they'd be more likely to ease up with first? Would it be interest rates or quantitative tightening? How do they play that out?
They have been pretty clear on this. They want the interest rate tool to be the tool that is their primary, weapon here. So what I think they really want to avoid is having people like you and me sitting here before every Fed meeting saying, what are they going to do with the Fed funds rate and what are they going to do with the balance sheet? Of course, Jay Powell got in trouble at the end of 2018 when he said it was on autopilot. People didn't like that. But let's use a different term. It's on cruise control. They don't want people sitting there thinking, what are they going to do with this tool and what are they going to do with that tool? Now, of course, at some point, they'll have to have a conversation about, are they at scarce reserves or less ample, whatever the term is, in reserves. But with an $8.1 trillion balance sheet, we're probably not there yet.
So I do expect downside here in the markets, and I do expect the data that we get, if it looks recessionary, from this point on, the markets are going to pay a lot more attention to it and potentially, take it a little bit more serious after the Fed basically showed their hand. Now, tomorrow morning, we're going to get the Philadelphia Fed Manufacturing Index at 8:30 a.m. Eastern Standard Time. We're expecting negative 0.7%. We have been negative on the Philadelphia Fed for a very, very long time, the past 18 months or so, and last month you were actually positive by 12. So that looked really good, but we're expecting to go negative again tomorrow. We're also going to get initial jobless claims for the week of September 16th, expecting 225,000. A big jump here would also not be great. We're also going to get Philly Fed new orders, Philly Fed prices paid, Philly Fed CapEx index, Philly Fed employment, Philly Fed business conditions as well. So watch out for that data coming tomorrow. And then tomorrow night, we're going to get the Japanese inflation rate, the core inflation rate as well, and the interest rate decision. And then on Friday, a lot of data out of Europe. Fed Cook that will be speaking, global S&P Global Manufacturing PMI, S&P Global Services PMI, S&P Global Composite PMI, all of that data coming out at 9:45 a.m. in the morning. So we don't have a lot of big economic data from now until the end of the week, but there is some that could be quite important. Now, I do think this Fed move, this digestion by the markets, is probably not going to be a great one. As you can see in after hours, the S&P down about 0.25%. The NASDAQ down exactly 0.25%. There is no bounce to speak of, and I think it's simple. The Fed just said we're going into recession. Now, should stocks be at close to all-time highs? The answer is no. So, it seems very logical and very healthy, actually, that the markets are selling down and will likely sell down for the next couple of days. Where does that take the S&P or the NASDAQ? I couldn't tell you. Maybe it's back to 420. That seems like a reasonable level. Maybe it's to 410 or 405 or 415. Those all seem like respectable levels, at least until we get clarity on when this recession is coming or how deep a recession could be. So I'm actually not expecting a huge collapse in the markets, but to kind of give you a percentage basis, down to 415 on the S&P would be a drop of about 5.5%. So I think that's kind of what we're looking at here. This would have a negative impact on Tesla stock as well here in the short term. I would like to point out that Tesla stock in after hours actually is one of the only big tech stocks that is green, up 0.16%. There is very positive things on the near-term horizon for Tesla, like the Cybertruck, like the Model 3 Highland, and let's be honest, if we go into a recession, well, doesn't matter all too much for Tesla when Tesla's estimates are already basically pricing in a recession already. Probably not the biggest deal. We're already expecting recessionary numbers from Tesla. 27% delivery growth, 29% EPS growth. That's pricing in a recession for Tesla. So it's one of those things where if we do go into recession at the same time, interest rates come down, more people might be able to buy themselves a Tesla. After all, your firm middle class that buys a Tesla anyways is probably only going to benefit, I would imagine, off of a shallow recession as far as purchasing power to buy homes or buy cars. And unless they lose their jobs, that firm middle class making in between $100,000 and $150,000 a year as a household, unless those individuals lose their jobs, well, you theoretically shouldn't see too much of a drag on Tesla's business. Obviously, the initial reaction of a recession, that tends to have a pretty contractionary effect on the economy. Usually when recession hits the news, a lot of people abruptly slow down their spending, which could make some sense. But I want to be very clear. I'm not in the slightest bit bearish for Tesla in 2024. I'm very, very bullish. But Tesla's share price the next couple of weeks, well, I'm bearish on the markets. I've been saying I was bearish on the markets. And you just seen the NASDAQ collapse 1.5% today. The S&P collapsed 1%. I'm not going to pat myself on the back because this call that I've been making has a lot more downside to go, but I have a feeling that downside is going to be recognized and we are going to be correct again here on this channel. Now, I'm not a financial advisor. I'm not a financial planner. I'm definitely not a fortune teller, so anything can happen. Position your portfolio accordingly, but it looks like we were right about the markets coming down, and it looks like the markets are going to come down even more, in my opinion. Now, where does that put Tesla stock? If the S&P drops 10%, the broader markets do fall about 5.5% as I expect. It's not unnormal or unnatural to see Tesla stock fall double that. So that would be a roughly 10% drop, give or take. That could put Tesla stock in that range of 240 to 235. Now, 240 seems like it will be a very strong level of support. So I would say 240 looks more likely than not. Over a 50% chance that we fall back to 240 based on my estimates of over a 50% chance that the markets could fall 5% or so over the next couple of trading days, call it the next week or two. There's obviously going to be aggressive bounces mixed in there, but this overall narrative of we're heading into recession, I think is here, and I think it is here to stay until we are proved otherwise. Now, if the markets were to fall to maybe 400 on the S&P, well, that would be a drop of closer to about 10%. That would put a 20% drop for Tesla likely, and that would put Tesla stock back at around 210. Good news for everyone. Tesla was just at about 210. Tesla just bottomed out at 212. So it really wouldn't be anything that's too out of the normal for Tesla. So I think Tesla could actually outperform the markets if the markets do fall. Again, keep in mind the Cybertruck, the refresh Model 3, some of the great things that are happening for Tesla stock heading into 2024. A licensing deal potentially for FSD. There's so many good things to speak of. You don't want to bet against Tesla here. In other news, Jeep maker Stellantis makes a new contract offer as auto workers prepare to extend their strike. Now, it does not look like the company's spokesperson actually made this information public. But as you know, the UAW said Friday, unless there is serious progress towards agreements with GM, Stellantis, and Ford, more factories will go for a strike. General Motors idles another auto plant, sending 2,000 workers home as the UAW strike deepens. Again, not good for the economy. Additionally, GM said they cannot provide supplemental unemployment benefits due to the specific circumstances of this situation. So not only did you get just laid off and you're not getting any extra kind of benefit from GM, you get $362 a week. You are at essentially financial rock bottom at that point. It does not get worse, at least financially speaking. This is not great. In a little bit of good news, you got to have a little bit of good news mixed in here with the bad. More than a fifth of new EU car registrations are now fully electric. This could represent opportunities for traditional and electric car makers across the continent. A record 21% of all new car registrations in the EU in August were those of battery electric vehicles. This is another point that I want to make, that if you continue to see adoption rates at the way they are, increasing at the pace they are, 2024 is going to be maybe not as bad on Tesla as it will be for other companies. Now, it says few have benefited more than Tesla, with its Model Y ranking as the best-selling EV in Europe for the 8th month in a row. And check this out. Lawyers who sued Tesla's board for excess pay want $10,000 an hour. And this was when the directors agreed in July to return more than $700 million in compensation to the automaker for allegedly overpaying themselves, are now seeking a huge payday of their own. The lawyers want a judge to approve $229 million in fees, or $10,690 an hour, according to a September 8th filing in the Delaware Court of Chancery. The proposed fee award, if approved, would be among the largest ever to result from a shareholder lawsuit filed against the board. The sum would be distributed among lawyers from 4 firms that spent several years building a case against the compensation paid to Tesla's directors from 2017 through 2020. The hearing is scheduled for October. So that is going to do it for this video. Hit the like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. If you like all of the in-depth kind of deep things we get into here in these videos, and if you just want to stay informed and up to date, hit that subscribe button. I believe we're the only channel in this community that goes over broader market topics that could affect the markets, and with the degree of reliability as we are, I think it's quite a gift in the community to be able to go over these things. And hopefully you guys like these kind of videos. I certainly like making them, so let me know down below in the comment section if these are more so videos you would like to continue to see. Things on the broader market that could, impact Tesla. I think that's pretty important for individuals to stay up to date with. So that is going to do it for this video. Thank you for watching. My name is Michael Tyler, and I will see you in the next one.